And today's topic is really interesting. It's called A Child Tax Journey from Zero Age to 100. And I know that all the parents are interested in knowing that. And the child journey, the child journey can be fascinating, and you could have a child and later on become the president of the United States. But that journey is not the one I'm talking about. And today, I just want to focus on your child from the day he's conceived all the way to 100 years old, and what kind of tax things that this child is going to have in this world, and as long as he's a US citizen, right? So we're talking about the US taxes. So here, before we get into talking about that, I do want to show you our website, communitycpa.com. Did you see that one? And there, the first one is actually our little commercials about how special we are. And right in the middle, this is Accounting Today. Accounting Today is one of the most dominating CPA accounting industry magazine, newspaper, and they actually publishes for many things like the elite partners and what kind of industry trend there is. So it's a publication that I would look into all the time when when I want to learn the industry a little more and knowing where we are. So they have done a survey with the CPA firms, having CPA firm come out to tell them that what they do with the technology. So our firm, just like many other firms, we fill up the survey, tell them what we do, and out of these survey, they select 10 firms to name them as a technology savvy or good with technology or leading technology. So they call them best firms for technology. So with that said, you see, we are actually one of the 10. So that tells you Community CPA is a firm that we care about the technology. And because we want our service to be not only accurate, but also efficient. And the last picture you see there, that is our Houston, Texas branch. So it's a building we purchased and we're doing renovation to get that going. So we think that we can have the Houston branch to come up in this year for sure, but August, probably in the beginning of August at this time. All right. So the other thing we would like to show you is actually the YouTube channel. And our YouTube channel stores our YouTubes. So if you, let's say today's webinar, after we talk about it, if you want to rewatch it, or if you want to send it out to somebody else, and you can definitely come to YouTube channel and to find today's webinar. All right. So let me now stop sharing and bring you to the slides that I prepared for today's session. So a child journey from age 0 to 100. Let's take a look. The first couple slides is about our firm. You know that we are 27 years old firm, and with 10 different languages are spoken inside of the firm by our staff. And we have clients really all over the country, all over the world. And we have 4 branches right now. So Houston, Texas is our 5th one. And I served on the Federal Advisory Committee to IRS for 3 years in the past. And I have written 2 books so far. One is 8 a.m., the other one is 10 a.m. I am writing the 2 p.m. as we speak. It's called Expanding Your Business. My 4th book, which is 6 p.m., will be the last one for the 4 books I planned. The 6 p.m. is retiring from your business. Maybe I would not call it as retiring from your business because it is really more of a repurpose of our life, right? When we get to a certain age. The webinar itself, we do want to say that there is a no responsibility disclaimer. So when you receive knowledges from here, and always take a critical view, right? Always question of what you know, what you learn, and especially something from internet. It is really very fluid, and there's a lot of wrong information on internet. And for us, for Community CPA, we know which industry we're in. So the webinar we come up is based on our study, our experience, our interpretation of rules and regulations. If there's anything that wasn't right, maybe rules and regulation changes, anything in that regard, and we would change that and with time. So when you watch our videos, just be time sensitive and don't watch videos that labeled as 2020 for PPP, then here talk about PPP because it's so outdated, right? We have like over 1,000 videos in our library, and you just type into the keyword, you're gonna find our videos. All right, now let's start our child journey. Age 0. What kind of taxes do you have on age 0, right? So these, a lot of these are really just the experience that we have and we put in here. Obviously, it's not all inclusive, but most important ones are all in here. So when you conceive with a child and you know the child is born and you are preparing for arrival, and your medical bills normally that come into play on your taxes on Schedule A, right? If it is over 7% of your total income, say your childbirth is a difficult one and you spend a lot of money, so you may have some deduction on Schedule A if it is over the standard deduction. And you may think of, oh, I'm going to have a child, so I'm going to buy a home and rent a new place. Do I have any benefit over this? So from time to time, a different state, county, and the federal government even, and they would have things more like the first home benefit, first home buyer benefit. And back in 2008, there is a thing called the first time home buyer tax credit that come out with the federal government, but we don't have anything in the federal government level right now. But in different state, you might look into, if you are the first home buyer, maybe the bank are actually can give you some leeways and the less down payment and the less rate because the bank have received certain fundings and support from the federal government or the state government. So those are the things you can look into to help you to lower your cost, and it reduces your cash outflow. But in terms of the taxes, and when you purchase a new home, some of the new home has a property tax abatement. So those are the tax savings you can look into. And if you rent a new place, some of the state has a renter credit, right? Those are the taxes you can look into. And to set up a life insurance, that is a long-term benefit for your unborn child, because say you buy a life insurance for yourself, you're the mom, and if you passed away, then the money goes to your child with no taxes, right? But you need to buy that life insurance now and pay, use your after-tax money to buy that. Then your child would have that money without needing to pay taxes. And you can also set up college funds for your unborn child. I know it is probably mechanically difficult for you to set up the funds when the kids is not here yet. So you want to wait the kids arrive, you have his or her social security number, then you can set up 529 plan to start putting in small dollars. I'll tell you, those are really make difference. I'll give you my personal experience. I actually didn't really buy any 529 plan. I kind of changed my ways of thinking how to support children over their university because I know they cost a lot. So what I did is I have a credit card that I use, and that credit card actually would deposit like 2% of the spending into the college funds. And believe it or not, when my son went to the college, and I have total of $38,000 in there to literally paid 1.5 semesters of the fee for the college. So you see how the college funds is drop in the bucket, but if you can just hold it over the time of your kids growing up, I mean, 18 years is a long time. You can say it is a short time, but those years and a month and days will help you save that funds. So buy child necessity items, those are normally not tax deductible. But just think of when your child grow up, if you want to donate that to the nonprofit organization, those are in-kind donations, and you can give a price and deduct that out of your tax return Schedule A. So that's so much about age 0. Now, let's look at age 1 to 13. And this child is you and yours. The reason I say that is, the child gonna be just you on your tax return, and you can split this child out, and it is yours, and you make all the decisions for the child. If your child happened to be a movie star, and the money that the child made, the contract they signed is all you. You're going to sign that contract for the child. You're going to be receiving that money to your household. So your child can literally become a support to your family life, just like Carissa Dan in Chinese culture. We know this singer, and she is the one supporting their family. Okay, and the child is a dependent on your return. So once they are your dependent, obviously because they are age 1 to 13, so they can get you the child tax credit. Okay, so in 2023, that's $2,000 per child. And they can also get you the dependent child care tax credit. And what that is if if two of you are both a working couple, and you bring your child to a daycare to be taken care of, and you're paying $2,000 a month, and that is a child care expense. That expense, 20 to 35% of that expense can qualify to get you $3,000 for one child as a child tax credit, and $6,000 for 2 or more. So if you have 5 child, you're just going to have up to $6,000. So dependent child care tax credit is available as long as they are not 14 yet. And child tax credit is still available. And then, of course, if you're a low income family, and then you're going to get earned income tax credit. I did not list that because that's not exactly related to your child. It's just you're low income, so you would qualify a low income tax credit. And if you have a child, the low income tax credit calculate a bigger amount for you. And when your child are in K to 12, the school sometimes have tuition, right? So if you go to private school, you have tuition fees that you're paying. That has a tax credit at the state level. Just go check your state legislature to find out what kind of tuition credit the state offers for K to 12. Like in Iowa, they offer for $250 for every $1,000 for the $1,000 tuition you paid. So it's up to 250. So each child has 250. And of course, when they are so little, sometimes a mom and dad are in business. They make their child be the child star, and doing their business advertising and making a little money here and there. And these are money deductible from your business, and it doesn't need to pay taxes on the child, but only limited to the Schedule C business, which is sole proprietorship, and also the partnership business. But if you have S corporation, C corporation, doesn't work that way. You cannot deduct your child labor and not to pay taxes, and only available to these type of business, which is sole proprietorship and also partnership. So when you have your own business, right? If it is a sole proprietorship or if it is a partnership, your child labor can come in. But let me explain about the partnership. When you pay your child in the partnership, you get a K1. You need to go to 1040 to deduct that expense under the supplemental income and expense sheet, which is a Schedule E. If you talk to your tax professionals, they understand, so you can deduct that from there. And your child don't need to pay any taxes, don't need to report any taxes, okay? But if your child is making money for you, being a child movie star, and then all the income are coming to your household and you are paying taxes on it, Okay, so that's the child 1 to 13 is really you, right? Everything is you, and you need to do everything for the child. And when the child turned age 14 to 17, so remember, after 13, they no longer can get the child daycare, child care credit, right? The care expenses is no longer there. So a lot of states has a law that to allow the kids to be home alone after 14. And because they don't have any cares credit anymore, and they are bigger child. But by the time they reach 17, this is where they would start losing. On the 17, this will be the last year they have child tax credit. They won't have child tax credit anymore. Okay, so within the 17, 14 to 17, you still have child tax credit. Okay, and they still you're dependent on your tax return. And but now, because they are teenager, so they might file his or her own tax return as your dependent. What I mean by saying that is, if your child and work for your S corporation and made a $400 income from you, your S corporation will deduct the $400. So your S corporation will not pay taxes on that 400. But your child has a 1099, then your child is required to file his or her own taxes as your dependent, means that they are not taking their standard deduction as a independent person. They are your dependent. So you're gonna file your child on your return. At the same time, your child gonna file a child taxes as well. So I listed the income threshold. Let's say for 2023, if your child made $13,850 from, say from um, some coffee shop they worked, and they should file taxes. But you still file them as your dependent, but they need to file their own taxes. So the same thing, if your child has an interest income on their account that's over 1,250, and they can file that on their own and as a as still as your dependent. So you don't have to report that 1,250 on your tax return. But you may say that, oh, what if I'm not doing that? I'm going to include that 1,250 interest income on my tax return, and I will include my kids as dependent. I don't want my kids to file. It is okay. Your kids don't have to file as long as the required threshold is not met. And if met, you include that on your tax return, then that only gonna be more beneficial to IRS because your rate is higher than your tax, than your child taxes when they file as a dependent to you, but with a return. So they might be your little trouble now, and they're making money out there, and they make mom and dad to still file as a dependent on your tax return, but they also need to file a tax return. And of course, no more dependent child care tax deduction. And the K to 12 tuition credit is still available. And the child labor for your Schedule C and the partnership business, that's still available. And you can do that. So, but not if when you have a corporation, right? So that's the difference between, at what time my child making money would need to be reported on his or her own. And if you have a corporation and whatever money you give to them is actually paid out, it doesn't qualify to be a child labor on your tax return. And so they would need to report that income. All right. What about 18 to 23? Now, you can still file your child as dependent, especially if they are in school and dependent on you. You are the one, filing taxes. And I have 3 children, and all of them were my dependent all the way to age 23, just because they were all in school at that age. But because they're going they're endless going to school. I have one kid with 3 degrees, so you can imagine that they were in school over age 23. Then when they are still in school over age 23, and that is when and you want to start moving them out. That's why I cut this off on the 23. Okay. The child does not need to be under parents as a dependent and during this age. They don't have to. And sometimes we see people that the parents, the child are applying for FAFSA, applying for college aid, and with the parents on the return, they don't get anything. But if the child is independent, making their own money, and then they can be independent, they can submit their own tax return to apply for the tuition's support, right? But of course, the college will make that determination, because if your child only make $5,000, be a barista at a Starbucks coffee, and then claiming that they support themselves, and so they file independent tax return, that just doesn't even make sense, because it's not enough money to support themselves. Obviously, you're the supporter, so you would claim them into the dependent. Why would sometimes the parents want the child to stay on the tax return to be a dependent? Not because of that little bit of calculation on the total deduction for the standard deduction. It is really about the college. So, if the child is in the college, you know how they pay tuition fees, and the parents or the child would receive this 1098T report, shows how much of tuition they paid for the year. That 1098T can be under the parent's tax return. You would get $2,000 tax credit out of that, and if they are your dependent. But if they're not your dependent, you cannot do that. So you would give that 1098T to the child. But if they don't even owe $2,000 taxes, then your credit will be wasted. So with that said, and a lot of times, whether they file dependent or independent, it is a calculation of financial situation. It is a financial decision the parents and the child would make. Okay, so now that's why I list the 18 to 23, because the majority of the kids are maybe in college. If they're in college, they're eligible to be your dependent. But if your child is 18 years old and working full time and raising their families, you can't bring your child in together with the grandchild saying, oh, they're my dependent. No, that doesn't work that way. So they'll only be your dependent because they're a full-time student. You support them more than 50%. Of course, your 529 plans start to disperse. You want to use that, right? If you have 3 children, like I do, then the first child I didn't use the 529 plan, but I start using it on the second and the third child. So you want to make sure you use up your 529 plan, because if you don't, if you take it out disqualified, then you have penalty and interest to pay. Of course, there's 2 major credit: American Opportunity Tax Credit, Lifetime Learning Credit. As long as your kid is in school, they are eligible for Lifetime Learning Credit. But for the first 2 years of the university, and they are qualified for American Opportunity Tax Credit. So those are the ones. Of course, you won't get that if you're ultra rich, and then your tax return gonna be your AGI is too high to get that. But normally, as a parent, you have a better chance to get that credit, and you can also try with your kids' return, your return, figuring out who would get the $2,000 more, get the full amount instead of just partial the return, right? Partial the credit. So that is where the 18 to 23. So it is a time period to the parents to realize that the kids can file their return now. It is not because they don't know how to file. It is because you know well how to file is the most beneficial situation. So maybe it is a period when your kids become 18 to 23, and it is good to look for tax professionals to evaluate your situation before you go on to file taxes for another 4 years, right? So you want to know your situation, then you go forward with that. And it is a year that can be very flexible. So what about 24 to 26? I list this one here because this is the age 24. Your child is officially considered on his or her own by um, many situation, or by many standards. For example, on tax side, and it is a, on his own situation before age 26. Though I put 26 here because there's a small things happening. The child can stay on your medical insurance before 26. And some of the medical insurance company will say that if they're still in school, they're less than 26, you can still include them in your policy. And most of the medical insurance that I come across is like that. So 26 and under, you can still shelter them, give them a good medical insurance. But it is really about the time they need to start working to support their own lifestyle. It is a weird time for parents to let go, but it's also an important time for kids to at least know what they want to do. So if you still have a child at age 24 after graduating or about to graduate from college, still don't know what they're going to do, then I mean, they are really spiritually still your dependent, but in reality, body wise, you have to throw them out. So it's not a good balance, but this is the age that things can get a little real for them. And you as a parent really should already be a empty nester. You should not have them around. So, and I hope you are, because if they are around, obviously if they have conditions, say they are severe, you know, they're severely impaired uh, for certain disorders or addictions, things like that, and you're still hovering around them, and then you can declare their disability and consider to have them stay on your tax return for eternity. I mean, of course, if they're disabled, they're incapable, and you are the parents and you should take care of them, right? And this is the time that you really should start walking your child to a tax office. They need to have their own relationship with the tax accountant to understand what they need to do for their taxes, because they really are in control now. Okay, if this child is going to help with your business, this is time to start planning for transition. I mean, your child is 26, you're not going to be 26, you're in your 50s. So it is time to really plan for that transition, because this transition is very important from tax standpoint. Let me just give you an example. I have a client who runs a factory. The factory is really start making a lot of money, and of course he runs it for, you know, almost nearly 20 years, and it wasn't really that great in the very beginning, but now he's in his 60s and his children are in their early 20s, and the business are taking up and it's really becoming well. So at this time, my client would transition shares to the children. So you know how we have a gift tax limitation every year, right? So the share was valued at 15,000 a share. Then every year, last year, he can only transfer one share to the kid, and which is tax free. So, you know, business is growing. So next year when you evaluate the business, it's not going to be 15,000 a share. It's going to be 30,000 a share. Then the kids would get 0.5 shares out of the business if we still go on to the gift limitation, right? So in this kind of situation, for our business owners, you want to start transition. Giving kids 1% is not going to hurt you. It's not going to give them much of a business either, but you transition that tax free. But if you don't do this and you wait till the end, and then you have this death tax in front of you, and if your wealth is more than 12.6% right now, 12.6 million right now, then you're going to end up paying estate tax, and the children is going to end up helping you paying taxes. So with that said, when your children is at this age, assuming you give birth in your 20s and the early 30s, then you are almost at your 50 and you need to start that transition. Of course, if your child is an entrepreneur like you, and maybe even have no boundary, just kind of creating business, failing business, and going on their merry ways, and they're just a big huge entrepreneurs but haven't been successful, then this is the child need a lot of tax hand holding. Every failure the child has in the early stage can become tax saving for the child in the future. Don't look at the losses as if they really lost it. No. In business, loss is like bank saving. It works the same way. And I say that, you probably goes, well, don't know why you are saying that. I have a reason why. If you go to our YouTube channel, you type in net operating loss, just NOL, and just learn all the webinars I put out there. What I was trying to tell folks is that if you're in business, you should not let go of any loss that you have happened in business, because they are your tax saving. All right. What if the child 27 to 37 at this age, your child should have his or own family life and his or her own career. You might find yourself start to have grandchildren, but keep in mind that your grandchildren is not going to be your dependent on your tax return. Unless the parents are really dysfunctional and maybe situation happened to your child and then you ended up getting them as dependent. But know that those are the dependent where when you file your taxes, if it is your grandchildren, and you want to make sure that your child did not file them as a dependent, and you want to coordinate that with your child and prove that you have support the grandchildren more than 50% of their lifestyle, and so you would qualify for that dependent. And it is also time to watch what your child is up to and how the family is planning for your retirement and the future your child the future that your child gonna see you go through. So what gonna be you, because you're gonna get a mandatory payment from your retirement money, and you may go like, I don't really need it and it's a little too much money, I'm going to give this to my children. Transition your business to your children. Hopefully you already done that before the child turning to 37. And but you also have giving children money or grandchildren money. Those money can be part of the gift and it should not be taxed. So you want to plan that. You may give your grandchildren money every year, and you may give your child every year, but stay under the gift tax threshold, right? So that would be something, and we always tell folks that to watch for the threshold. And the gift tax threshold every year changes, and you can just, now everybody know how to Google. You can just literally Google to figure out what that is. But you cannot be like, oh, I forgot to do that last year. Let's do that now for 2023. No, right now you're doing it for 2024. So this is where you want to be very vigilant, understand that how your relationship with your grandchildren and as your children, and they of course no longer part of your tax return, but they can be part of your tax saving for your business by start transitioning early. I mean early in their 20s and 30s. All right. So now let's look at what happened. They are 38 to 50. I mean, this is right now, right now, I don't know about 20 years later, but right now, I felt this generation, this young generation, they just getting mature at this age group. They live to age 38, act like 18. So in between, there's 20 years missing out of these young people. I don't know, must be the parents has such a, we have done such a good job to spoil our children. So none of them really understand, you know, age means what. So they're just in their own mind living their good life, right? And now this is the time when your child turn to 38 and 50, they become your good child. Most of them, almost all of them, the client's child I see is that way. They become a good child. They come with mom and dad to do mom and dad's tax return. And they are named as trustee for mom and dad's living trust. Okay. And you as parent probably really stepped away from your business already and already kind of hand that over to your children, to your child. So it's their thing now. You are at the time to wish that your child would care for you when you needed that help. Okay. So this is where when you stage yourself into the retirement, earlier we talked about transition the business, right? So you're being the mentor, you transition. So at this time, you're pretty much done with transition. So what you can have with your children from the tax standpoint. So this is where the children gonna they are going to plan their taxes. So they may be doing so well that they need a mom and dad to take some income from them. So they want to pay mom and dad. So you can turn around, use the money to pay a nurse, to pay a babysitter. You know, we call ourselves babies. So yes. So we pay a babysitter to baby us, right? So those are the things your child could do for you when they do well. And you are at the place when your child is 50, you are old. Okay. So you need to finalize your will, update your living trust, and whenever there is a triggering event, like a grandchild is born and your child got married the third time, you know, and or spouse passed away or you won lottery. And those are all triggering events. Go back to your living trust and update it. And depends on how good your children are. Maybe you just discovered one of your child is actually alcoholic and which you did not know before. Then you want to remove that child from trustee and making sure that you have someone more reliable to handle your affairs if you are not here. So those are the things we as parents are just gonna watch what our child gonna be from 38 to 50, and knowing that this is the age majority of taxpayers are paying the most taxes. So your child at that age is a heavy taxpayer, and you want to teach them to go for professionals when they are successful. If they're not successful, they're relying on social welfare, then there is a places to file taxes for free. So you want them to not spend any money and go get a places they can get free services, right? It's still your responsibility. Once your child is forever your child, what can you do? And you can't get rid of your child, right? So it's just really for parents, I felt like if we could look at our children by age group, knowing when they come to certain age what we need to do, it will be a mental relief for us knowing that those are responsibility we have, but the rest of it is not our responsibility. And really, other than finance side of things, I felt like the child growing up to 38, 50 years old, they're done. They already know what they're doing. And if they're good, they're good. If they're not good, hopefully they turn good. But it will be a battle. It will be a difficult life. But not to say there are people, oh, have a good life. No, some have difficult life. Okay. Now, when your child turns 51 to 70, you might still be around and hopefully, and they are on their own. At this time, and all of your children will be very understanding of you at old age. Majority of the children, I would not say all, right? And but in my life environment, in my personal life situation, and I see, you know, my dad passed away at age 90. My mom still live and she's 90 years old. And knowing how us taking care of her, knowing how our understanding changes with myself turning 50, and I actually understand, um, how profound that is to have a child that live a normal life, have getting married, children, school, university, and the business. So all of that regular things we talk about, the boring life we were talking about, it is important at this age for the parents because when the child arrive 51 to 70, the understanding to their parent is so great. And I gain new insight for my parents, for my mom, and I don't get upset with my mom, doing things that is just not rational. And I understand and I have so much tolerance and I didn't even know it was in me, but I understood it, right? So as a child, I grow to this age group. And if they are, um, if they are on their own, and they are doing well, they will care about the parents. But if they are struggling, and you may end up still really watch over that child and trying to provide funds to them. So I want to talk to the parents that when you split your retirement funds to one of your child who is not making it, when you do that, and you either report that as your regular expenses, so you pay taxes on it, or so this is normally what parents would do, just give to the child, never account it to anything, and assuming they just bought things from Walmart like that. But for some parents, they would file gift tax return because they are going over that limitation. 15,000, 17,000 each year, that number can change. And then, or they can actually have a note saying you owe mom. So this child promised that to pay mom back. So in any case, so you want to know that you can give, but if your giving is not like you donate, you can deduct it on Schedule A. And this giving, if you just supply their life and you still report taxes on your own, paying taxes on the mandatory retirement distribution, then of course it's just how you spend money and you do what you like. You want to give to your children, that's fine. But if it is something you're giving to your children and exceeding so much money has become a gift tax situation, then you need to file gift tax. Okay. So with that said, you know that giving to your adult child is not totally free. It's not tax free. And you either file gift tax or you write a note they owe you. And if you don't, if you write a note say they owe you, and if you passed away and that amount is still owed, and it can easily, I have never seen that happen, but in theory, it can become the income for the child because he borrowed money and never paid back. So it's 1099-C. Okay. So with that said, and I just think we don't need to make so complicated. You just know that you can split your retirement money to your children, but you pay taxes on your own, then your children don't have to bother, right? And that is the 70. What when your child is 71 to 100? So, this age group, people go away. So if it is your child landing in this age group, it probably at some point of time would pass away. And hopefully at that time, you are meeting your child in heaven. You circulate the whole life circle. And for tax journey, and depends on where your child is in terms of his wealth accumulation from age 24 all the way to the day he died. And that determination depends, would determine whether your child need to file estate tax return and of course, need to file the last year tax return to conclude his life with IRS, right? But he also need to file another tax return to conclude his wealth. But if his wealth is under the estate threshold, he may not need to do one, but it's always recommended that if you have wealth accumulated and do an estate tax return. So that return will finalize the distribution of your estate, of your child estate. Maybe if your child passed away early and he made a lot of money, maybe some of the money would even come to you, like Michael Jackson, right? Michael Jackson's mom would get part of the child estate. And because the child passed away before her and has left accumulated wealth, a big deal, right? And it is never right for parents to send off a child, no matter how old the child is. I know that's so hard. And in Chinese, we we have a saying goes, 白发人送黑发人, which is a very sad event, which says that the white-haired people sending off the black-haired people, and that just is an event that should not happen in that sequence. We should be all going through life properly into our ending, right? So, but it does happen. If that happened, you know that your child has a tax situation, and you as a parent maybe couldn't really help much because he has a spouse or she has a spouse, and things are taken care of by the other person. But still, that's your child tax journey. He need to file the final tax return. All right. As a parent, you might not know how much, but you know this is the part of tax journey. And with working with the spouse or even the children of your child, and to sort out the tax situation for your child. If your child happen to owe, you know, a lot of taxes when he died, and they will die with him. And those taxes, those his own or her own income taxes, not going to come back to haunt the children. So know that it is his responsibility. And in reality, even if they didn't die, if you have income tax liability dragged down for 10 years, and the IRS will write off your liability. That's just how it is. So it doesn't last forever. So I always told folks that if you have to owe money to someone, owing money to the IRS is probably the best way to the best way for you to live a life normal, because IRS would always work with you civilized, and it won't be knocking your doors, taking your license plate off and things like that, which the state government would do. So I would not recommend any taxpayer to owe anything to the state. They're too close to home. They have too much of you in their hand, and your driver license, your property tax, and your house, and you just can't get away. So with that said, as a parent, when we look at a child life and we know that what they need to they need to do in their adulthood, And if they really run into a complex situation with taxes, you can always find capable people to help him, help her. And as a parent, I know you never will get away from responsibility. You just can't. And I don't care how you say it. And as a parent, they're always our child. You always is responsible. But as long as you understand the tax journey of your child, I hope you can navigate this smartly and also alleviate some burdens. Maybe you're thinking, oh, my child owes so much money of this and that, and they're gonna be on mine. No, your child is adult. They sign their own loans as long as you don't co-sign them and it's not your responsibility. All right. And this kind of walkthrough 0 to 100, what do you think about the content, folks? And here is our website on our Community CPA website. You can actually make appointment with us online. These are the partners we listed. Each one of us chair a different area of taxes, different area of a business. So you see me, a CEO and managing partner, and you have Dr. Hao, Dan Kim, Sang Mo, Kwan Chung Jung Wad, and Derek Sa. So we each one of them has a specialty, so you can book their time to see them. And also, our website address is here, folks. And we actually getting to 6,000 subscribership. So I want you to subscribe to our channel and encourage us in that way. And we are a CPA firm open 6 days a week, Monday to Saturday. And our hours during the day is 8:30 to 5:30. We hope to see you. And like I said, we are opening up the number 5 Houston branch. And if you're in Houston Galleria area, come to visit Community CPA. We're there. And thank you so much for putting up with my voice. And I hope it is still good webinar and with the content. And I will see you again on Tuesday. Bye bye.